Hi, and welcome back to our edition of Technically Speaking. My name is Violeta Tudorova, and I'm Senior Market Analyst at Legacy FX. Chances of a markets-led recession arriving sooner than expected are growing, as the US economy is slowing dramatically. A meltdown in US equities, driven by pessimism about the economic outlook, is boosting the risk of a recession that could arrive sooner than many anticipate. Global stock markets have been under intense selling pressure since January and are now being accompanied by weaker corporate outlooks. The median expectation is for inflation-adjusted US growth to slow to 1.8% year-over-year in the fourth quarter. Slowing growth is almost certainly on the cards, and the steeper the fall-off in asset prices increases the odds of a recession happening sooner rather than later. US data released on Tuesday showed that new home sales plunged in April and business expanded at the slowest pace in months. However, other recent data suggested the American consumer is still healthy, with retail sales solid last month. But optimism was quickly extinguished by earnings misses from some retailers. The US economy shrank 1.4% during the first quarter. A contraction chalked up to a record US international trade deficit, following a 6.9% surge in GDP in the final 3 months of 2021. The National Bureau of Economic Research defines a recession as a significant decline in activity lasting more than a few months, which can make it hard to see one has already started. The list of downside risks plaguing financial markets and the economy includes inflation running at four-decade high, the beginning of the Federal Reserve interest rate hike cycle, Russia's war in Ukraine, supply chain disruptions, and China's COVID-19 lockdowns. Earlier this year, investors were grappling with valuation problems as the Fed began rising interest rates from almost zero, leading to a correction in asset prices. Now the market is starting to see the potential that inflation won't be controlled as quickly as we would hope, and that measures by central banks are going to squash growth, which could push stock markets even further down. On another hand, midterm election years have been tough for markets. US stocks have lost more than 17% on average, peak to trough, with market bottoms during this year occurring later in the year. From a technical perspective, number of key support levels on the charts have been broken this year, with large top reversal patterns evident on all US equity indices. Momentum indicators have been into a bear market territory for more than a month, showing that internal momentum conditions are weak. We expect volatility to remain elevated throughout the year, with corrective bounces along the way likely to be short-lived. Our downside target for the Dow Jones Industrial Average Index is 34,100 points. For the S&P 500 index is 3,400 points, and for the Nasdaq 100 index is 9,900 points. Thank you very much for tuning in. See you next time.